Okay, folks, can you hear me? Welcome. I'm going to torture you for the next 15 weeks, and I can't wait for this to happen. I have 4 kids. They've all grown up now, and all of them came and looked at NYU. None of them came to NYU. So when they were on their college expedition and they take you around the university and they lie to you, right? They say professors are always around. You can knock on their doors and go in. You've heard those pitches, right? I went with each of my kids on the NYU pitch. I kept my mouth shut. But when they get on top of the Tisch, the front of Tisch, they would all say the biggest classroom in the university is right under that, talking about this. This used to be called Schimmel. It's now called Paulson, depending on who's given the most money recently, I guess. Right? And they'd say, but no classes are ever taught there. It's just for show. And I almost, because I've taught only in this room now for 23 years. I hate this room. It's got the ambiance of Madison Square Garden when the Knicks are losing, but it is the biggest room that they can find in this building. So we're stuck with it. One thing I don't like about this room is because you don't have a desk in front of you, you can't put your name up. So, you know, it's more difficult for me to attach names to faces. I'm going to try. But before I talk about the class and what's coming, I'm going to do a quiz. In fact, this is going, don't worry, there are no grades attached to this quiz. But every class, we're going to start with a quiz. You know what we're going to test on? What we're going to talk about for the next 75 minutes. It's reversed, right? You're supposed to do the quiz at the end. The reason I do that is almost everything I say is common sense. You could figure it out yourself. And I want to give you a chance to reason your way to an answer. And after the next 75 minutes, say, why did I waste my money on tuition? I knew this already. That's mission accomplished. So we're going to start today's class with a quiz. And this is going to be a little personal. Don't worry about it. I won't remember what you told me anyway. So here's my first question. If I asked you why you were taking this class, give me the reason you're in this class. And I'll give you the potential reasons. As I said, you don't have to tell anybody else, so just basically for yourself. Is it because you think after you take this class, you're going to get rich like your neighbor, your friend who bought Bitcoin at 500 and now is very wealthy and retired? Maybe it's because you think it'll help you get a job at an investment bank or a hedge fund or a private equity house. Maybe it's to impress your friends and family because you can talk about valuation and they have no idea what you're talking about. Maybe it's because it'll give you the tools to recognize when you're fooling yourself. The biggest challenge in investing is being honest with yourself. And we lie to ourselves all the time, not just in investing, but in life. We keep telling we're good people, we don't cut to the front of the line, et cetera, and we break those rules all the time. Maybe this class will help you be more honest with yourself. Maybe you've been told it's an easy A. It's not, but maybe you've been told that. No. And maybe you're doing this for the same reason. Most people buy Tesla or sell Bitcoin or do whatever else because everybody else is doing it. As I said, you don't have to tell me. I'm going to tell you why I think you should take this class in a few minutes, or maybe not take this class in a few minutes. Maybe I'll talk you out of the class. That's not my intent, but I'm going to be pretty open about what I hope this class will accomplish. But file that away. Let's see, why is my... Second question. If I asked you, this is a class about valuation, and each of you has a fuzzy idea right now of what in fact, this class I think is called equity valuation. It's just valuation. So take the equity out. I don't care what they call it. It's a valuation class. It's exactly the same class that will be teaching the MBA starting a week from now. They have 26 sessions, but it's 80 minutes. So basically it's the same class, exactly the same material. Okay. But here's the question that I have for you. If I ask you to describe valuation as a discipline, again, for the moment, make your choice, we'll come back and talk about it for the rest of the day. Which of the following statements do you think best describes valuation? It's a science, it's an art, it's magic, white or black magic, you can make the decision. Or maybe none of the above, maybe none of those words fits what we're going to see. It's not working. There you go. Third question. As I said, this is a very unfair quiz because I'm asking you about a class that I've structured I'm going to teach, and I'm asking you what should be in the class. So here's a question about valuing companies. And the question is about which of the following companies is going to be easiest to value. You're saying, I've never done valuation. You don't need to do valuation to be able to answer the question. The first, so here are the choices. You're a mature company. You've been around a long time. You have a business model. You have a lot of financials, and you're in a stable economy. Second, you're a mature company, but the economy is in crisis. Doesn't have to be an emerging market economy. It could be a domestic economy in March of 2020. Remember, in the midst of COVID, we had no idea what was coming. A young company in a stable market, or a young company in crisis. So basically two combinations, right? Would you rather value a mature company or a young company in an economy that's stable or in a crisis? This one you probably can answer right now. Which of those four groupings is going to be easiest to value? For stable or young? Stable. Why? You have lots of data, right? You have a crutch. You have a business model. You can see exactly how they make money. And stable economy or economy in crisis? A stable economy. Who wants to deal with inflation and what the Fed might do and whether the economy will open up? Final question. Really starting to bug me. This is a personal question. There's no right answer. Each of us is more comfortable either working with numbers or with stories. And you made that judgment very early on. I'll tell you when I made that judgment. It was when I was 12 years old. It was after my first English literature class. I was asked to read Moby Dick, and I did. I was a good kid. I came prepared for a discussion of whales and captains. And about 20 minutes into the session, I noticed that the instructor was talking about neither. So I put up my hand and said, when are we going to talk about the whale? She said, there is no whale. And I said, what, did I read the wrong book? I distinctly remember a big fish going all the way through the book. She said, it's a metaphor. My jaw dropped. And the rest of the class was about hidden meanings in things that didn't even know had a meaning in the first place. I remember coming out of that class with a singular conclusion. I said, never again am I going to subject myself to that kind of bullshit. And I avoided the literature classes like the plague. I'm not comfortable with this hidden meaning stuff. It was Algebra 1, Algebra 2, Algebra 3 out of high school. And these were the good old days. You know what's true of the good old days? You went to college and you took the courses you wanted to take, as opposed to the stupid core curriculum they make you go through. Why do you have to take a history class? Because it'll round out your education. You know what? They're lying. You know why you need to take the history class? Because if they didn't force you to take the history class, there would be no need for a history department. Who voluntarily says, I want to take a history class? But then you could take numbers class, numbers degree, engineer, accountant. And then you took a numbers job. And who do you hang out with? Other numbers people. And what class are you in? Evaluation class, right? You're saying, this is my arena. But some of you, so let's do a show of hands. How many of you think you're more naturally numbers people? Okay. How many of you are more story people? How many of you think you're so rounded that you can do everything? There's some of you say, I'm both a numbers and a story, but there's one side you favor. Today, I'm going to talk about which of these skills you will need in valuation, and you might be surprised at the answer. So you ready? Let's put this away and start on the logistics of this class. Okay. I came to NYU in 1986. I was hired as an assistant professor. So I land up in New York. I went to UCLA, and the first thing I noticed was weather's not as nice. And they give me a class to teach. It's called security analysis. Have any of you heard of this class? It's a class with a very long and hoary tradition. It was a class taught in the 1950s at Columbia University by a guy called Ben Graham. You might have heard of him. If you haven't heard of him, you've heard of his most famous student. Anybody want to guess who's Warren Buffett, right? It's a class that's been taught forever. So they give me this class. I take one look at the class, and they say, I don't want to teach this class. Not a great attitude for an assistant professor who's just been hired, right? They should have fired me on the spot. But the head of the department was a good guy. He said, what would you like to teach instead? I said, I'd like to teach a valuation class. And I still remember what he said. He said, don't do it. There isn't enough stuff in valuation to fill a class. You know what? He was absolutely right. In 1986, there wasn't enough stuff in valuation to fill a class. There were no books on valuation unless you wanted to use Ben Graham's security analysis. You know when the first edition of that book was published? 1934. Reflects the time it was written, right? Coming out of the Great Depression. If you ever wondered why Graham's security analysis is so conservative, you'd be conservative too if you'd lived through the Great Depression. There were no books, but I really, really wanted to teach this class. And I discovered very early in my academic life that if you want to get anything done at a university, the best way to do it is to do it subversively. Because if you try to get official permission, you know what would happen, right? A committee would be formed. If you guys had experience with committees being formed, get used to it, because what happens is committees meet, and they forget what they're meeting about, and they keep meeting. And then there are baby committees that they call subcommittees and subcommittees. It's all very incestuous, committees reporting to each other. And if I let it play out, 35 years later, they'd come back and say, you can teach the class, but I'd be too old to do it. So I said, I'll teach your damn security analysis class. I didn't use the word damn, it's the head of the department after all. And I walked into the room, shut the door. And remember, this was 1986. There were no cameras in the classroom. They had no idea what I was doing inside that room. I could be teaching cooking for 15 weeks. And if I gave everybody A's, nobody's complaining. And I taught a valuation class. You know how long it took them to catch on? In 2008, I get a call from the dean's office. So we hear you're teaching a valuation class. I said, yes, I've been doing it for 22 years. They said, we don't see it listed anywhere in the course listings. I said, that's easy to explain. I've been hijacking all these other classes you've been giving me and teaching valuation instead. You made me teach this class called Equity Instruments and Markets. You know what? I'm not interested in instruments. I don't care about markets. And I'm not even that fascinated with equity. You take those three words out, what are you left with? And I might as well teach a valuation class. They said, that's not right. We should call it valuation. I said, I agree. So if you look at the MBA course listings, you'll see valuation show up for the first time in 2009. And soon after, the undergraduates also listed it. For some reason, the undergraduate program seems to want to call classes something different. Don't ask me why. They called it equity valuation. But last spring, when I taught valuation to the MBAs and undergraduates, just like I'm doing this year, for my 59th and 60th semesters teaching valuation. And I'm going to say something about this class that's going to encapsulate how I think about valuation, how you're going to see me teach valuation. Everything I know about valuation, I've learned in the course of teaching this class. Let me repeat that again. Everything I know about valuation, I've learned in the course of teaching this class. I'll give you a few examples. 1 year into teaching this class, 1987, we're still downtown. And at that time, NYU's graduate business school was right next to the American Stock Exchange. I taught my valuation class in the morning. I come back to my office. I look out of my window and I can see everybody from the American Stock Exchange floor is out on the street. So what happened? Fire alarm went off. It was October 19th of 1987. Anybody remember what happened that day? It's too long ago. Yeah. It was a one-day bear market. You know what the S&P 500 was down by in that one day? 22%. Think about that. If today we had an equivalent day, the Dow would be down 8,000 points. We'd freak out, right? And people were freaked out. The end of the world was coming. 2 days later, I was in front of my valuation class. And guess what the first question I was asked was? How with your valuation tools can you explain a one-day drop in the entire, it's not one stock, it's the entire market. How do you explain a 22% drop? I didn't know the answer, but I tried. This is going to be a pattern. You notice me. Even when I don't know the answer, I'll just make up stuff. I tried, but in the process, I started thinking about how do you explain market crises? And it stood me in good stead. So when the COVID crash happened in the first few months of 2020, I went back to what I learned on that day on October 19th of 1987. Move forward a decade in the 1990s. And we discovered, or we saw, a phenomenon we'd never seen in public markets before. Young companies with lots of potential, no established business model going into markets. Those companies were always around, but before the 1990s, venture capitalists invest in the companies. Remember, companies like Apple and Microsoft, when they went public in the 1980s, were already established companies in terms of a business model. But for the first time in the 1990s, you saw these companies jump the queue and go public. I still remember the day in 1997. Somebody in my class put up their hand and said, can you value this company called Amazon.com? You know what Amazon did in 1997? It was an online book retailer, tiny company, big money losing company. And like a fool, I said, let's try. And I valued Amazon.com in class that year. And when I tried to value it and I looked at the established literature, there was nothing there about how to value companies that had lots of potential, but were money losing with small revenues. But I had to come up with ways of doing it. I still tell people everything I know about valuing young companies, I learned in the process of valuing Amazon in 1997. You're going to see a few later valuations of Amazon that I've done. But that first valuation was a slog because everything had to be figured out. Then you move forward another decade. You're in 2008. You're in a full-fledged market crisis, but the market crisis created by banks behaving badly. And again, somebody puts up their hand and says, why when banks behave badly and they take bad risks, should the rest of us feel the pain? And to talk about how when banks behave badly, there are side costs for everybody else and everybody else's values impacted. Again, something I hadn't thought about till 2008. And then you get to the last decade. I call this a decade of the numbers company. And I'll explain. It's a decade where you saw companies like Facebook and Twitter and a whole host of social media companies go public. Let me ask you a question. What is the most impressive number at Facebook, other than the billions of dollars they're throwing down a hole called metaverse? No, but take a step back from it. What's the most impressive number at Facebook? Is it their revenues? No, lots of companies have more revenues. Subscribers, right? It's in terms of entertainment companies, I'm sorry, users, basically, because how many users does Facebook have in their ecosystem? You count Facebook, Instagram, WhatsApp, about 3 billion users. Scary number, right? 1 out of every 2 adults walking the face of the earth is in the Facebook ecosystem. Not revenues, not earnings. With Netflix, it's number of subscribers. No entertainment company until Netflix came along had that many subscribers, 220 million subscribers. With Uber, it was the fact there were 100 million riders. You see where I'm going? Until the last decade, when companies wanted to impress you, they talked about revenues and earnings, and all of a sudden companies are talking about users and subscribers and customer numbers. And in 2017 again, this is how every single question I have in this class gets triggered. Somebody puts up their hand and says, can you value a Netflix subscriber? Notice the question, not can you value Netflix? Because you can always value Netflix from the top down, but can you value a subscriber to Netflix? Can you? Help me out. How would you value a Netflix subscriber? What would you need to know? First is cost of acquiring a subscriber, but once you've acquired the subscriber, what's the value of the subscriber? What does Netflix get? Are you a Netflix subscriber? Let me pick on somebody. Are you a Netflix subscriber? Okay. So what do you do for Netflix every month? Pay a subscription fee, right? $15 a month, $22, depending on whether you get the premium subscription where 4 people can watch at a time or 2 people. I assume you do the only $15 a month. Yeah. So basically, I know Netflix gets about $180 a year from you. But to value you as a subscriber, you know what else I have to estimate, right? How long will you stay on as a subscriber? In user-based companies, this is based on what's called the churn rate. Now, how many times, and let's face it, subscription-based models are sticky. This morning, I was making a list of all the subscriptions I have. I said, really? I've been subscribing to that for 4 years. I've never even been there. So if I give you the expected life that a subscriber stays on and what you can collect from a subscriber, and if you can tell me what it costs you to service a subscriber, I can value a subscriber. So in 2017, I valued a Netflix subscriber. It took a couple of weeks to develop the framework, but then I used it to value a Spotify subscriber, an Amazon Prime member, an Uber rider. Different models, but basically the same principles. Again, I hadn't thought about that till somebody asked that question. And then you get to 2020. And I was actually teaching this class in the spring semester. January, February, look, just like any other semester. And we come back in early March and we get this notification from NYU saying, go home. 3 weeks, but you'll be back. 3 weeks, right. We went home and we were gone for like a year and a half. But I was teaching the class still from my home in La Jolla. I don't live in New York, I live in California for obvious reasons, other than the fact that I like to pay taxes. Okay? But I was teaching the class, but I was teaching the class in the midst of an experiment that had never been run before. You know what the experiment was? We shut the global economy down. We had no idea what would happen when we tried to open it. It's like turning a big machine off, say, please God, when we turn it back on, let it come on. So I remember at the end of March, in the middle of the class, I said, let's value Boeing. And if you remember, at the end of March, Boeing looked like it might never really come back because you sell to the airlines are not flying. What happens? And I remember many people saying, hey, let's wait for this to pass. That's not a choice, right? You got to value companies in the world you're in, not the world you wished you were in. I actually have a YouTube video that you can see of my Boeing valuation from March 23rd of 2020, the absolute bottom of that crisis. But again, in the process of doing it, I learned about what to, in fact, during the Russian invasion of Ukraine, I tried to value Ukrainian mining company. I have to confess, finally, I had to give up. This is beyond my reach, even in terms of uncertainty. You're saying, but those were interesting semesters. Ours is so boring. Trust me, interesting things will happen in the next 4 months. And be careful what you wish for when you wish for interesting things. Because what's the Chinese curse? May you live in interesting times. We're living in interesting times. Who knows what the next 4 months will deliver? So this is a class that, reflects my 36, 37 years of teaching the class and all of the bad and good experience along the way. And hopefully somewhere in this process, So what I'd like to do, first, let me do the logistical part before I do this. Finally, we're in person. I taught this class entirely online one semester, 2021. My office is in the other building, 969. So, if you want to find me, you can try, but I'm usually not there. Okay. My email address is, right up there. If you want to send me missives in the middle of the night, I'll read the next morning. My homepage, and I'll come back and talk about what you will find for this class on there. I don't use Brightspace or whatever learning management system is. I act like I do, but no, really everything happens on my site. I have office hours just before my classes, because I teach the MBA class just before yours from 1:30 to 3, 12 to 1:15. But I have a principle called the fair game principle. You know how it works? If you find me, I'm fair game. Which means for the next 15 weeks, I'm going to try to make it as difficult as possible for you to find me. For instance, I've discovered that if you take the stairs, nobody finds you. Because everybody takes the elevators. If you take the elevators, now I remember one year when I was teaching this class, at that time, there used to be a building called Coles, where you have the new building now. So it used to be the gym for NYU. And I'd show up, in the middle of the day to do my workout, and the person from the class I was teaching that semester would show up at exactly the same time, get on the treadmill right next to mine, and ask me questions all the way through. So I will introduce a rule that if my heartbeat exceeds 120 per second or whatever it is, I'm not responsible for any of the answers I will get. But truly speaking, if you find me, I'm fair game. So if you have any questions, try to find me. The teaching Kathleen is right here. So, and Allison will be back by Wednesday. So they will be the TAs. They don't grade the stuff. I do your grading. So if you get pissed off, it's me you got to take it out on. But I'll be sending out their office hours, and they'll do a review session each week where they work through prompts from past quizzes. So take advantage of that. So with that lead in, what I'd like to do is talk a little bit about the broad themes for this class. And what I'm going to say for the next 30 minutes or so is, to me, the most critical part of the class. Everything else is icing on the cake. So let's start with the first question I asked you: is valuation a science or an art? It's a question I get asked all the time. So let's dig through it. Is valuation a science? Let's ask a simpler question. Is mathematics a science? It's the only pure science. In fact, mathematicians are convinced that the rest of us are imposters. So let me ask you a follow-up question. What is it about mathematics that makes it a science? It's absolute, right? What's 2 plus 3? I'm not testing you. 2 plus 3 is 5. Right hand, left hand, calculator, computer, North Pole, South Pole. It's not might be 5, it could be 5. It is 5. And if you get any other answer, you're wrong. Physics is mostly a science, right? You all go to the 11th floor, you jump out of a window. Can you get a window open? I don't know, but let's say you jump out of a window. You don't fall in the order of your IQs or where you are in the corporate hierarchy. You just fall. Laws of gravity are the laws of gravity. Physics is mostly a science. But if the essence of a science is you get the inputs right, you're going to get the output right, is there any chance that valuation can be a science? I'm just finishing my updated valuation of Tesla. I started yesterday. I hope to be done by tomorrow and perhaps put it out there. I'm trying my best. You know how many uncertainties you have to deal with when you value Tesla? In addition to all of the uncertainties you deal with in a normal company, you have a teenager running the company, right? A visionary teenager, but he does some, you know what the essence of a teenager is? I'm calling them corporate teenagers. What do? They do what and you remember these days, not that long ago. What do teenagers do? Every day they get up, they look in the mirror, and they say, I have lots of potential. What can I do today to screw it all up? So there's an immense amount of uncertainty. I'm going to try my best. I'm going to make my best inputs, but guess what? The value that I get is going to be absolutely wrong because things will happen. Valuation can never be a science. And the sooner we accept that, the healthier the discussion of valuation will become. You know what? I am not a great fan of accounting valuation. Accountants have felt left out for a while. They want to be relevant again. So they've jumped into my arena and they keep trying to do things in valuation, but they think like accountants do, which is when in doubt, write a few more rules. They want to convert valuation to science, and they're convinced that if they write more rules, it's going to become more scientific. It's going nowhere. Valuation is definitely not a science. So it must be an art, right? So let's take a simpler example. Is painting an art? Not painting your house, you know, paintings, I'm talking about the ones in the museums. No. I still remember when my oldest son, he's now 33, when he was 8 years old, I took him to the Met for a Picasso exhibit. He lasted about 30 minutes. That's how long 8-year-olds last in a museum. And we come out and I said, Ryan, what do you think of that exhibit? He said, Dad, I was not impressed. I said, what? It's a Picasso exhibit. He said, this guy can't get the nose in the right place. Have you noticed it about Picasso? The nose comes out of the side of the head, the top of the head, the back of the head. He was either drugged or drunk. Given Picasso's history, he's probably both. But whatever the reason, we've decided collectively that Picassos are special and we pay. Thank God my son is not the appraiser of Picassos. They'll be going for 50 cents a piece. The essence of an art is it really cannot be taught. Thank God valuation is not an art. I wasted 37 years of my life trying to teach something that cannot be taught. So if it's not a science and it's not an art, what the heck is it? The word I use to describe valuation is it's a craft. I'll tell you the discipline that I think comes closest to valuation. It's cooking. Think of how you learn cooking. You could watch cooking shows, right? My daughter used to watch the Food Network all day long, chopped episode after chopped episode, beat Bobby Flay. For a long time, she couldn't cook a lick, but she knew exactly in theory how you made a souffle. You don't learn cooking by watching cooking shows. You don't learn cooking by reading cookbooks. You learn cooking by cooking. And the first time you cook, what happens? Disaster. Fire alarms go off. I still remember the first time I scrambled eggs. Nobody told me I was supposed to spray the damn pan. I finished. Egg looks good, but it won't come off the pan. Pan and egg go in the trash. And I remembered a very important lesson that I've remembered since. Spray the pan before you cook the egg. You learn cooking by doing. And the first time you do it will be difficult. Remember that. You learn valuation by doing, which means the next 15 weeks are, in a sense, if all you do is come to classes, work through problems, you're not learning valuation. You learn valuation by doing. And the more companies you value and the more diverse the companies become, the better you will become. If all you do is cook pasta after pasta, you'll get really good at cooking pasta. But if I said, can you make me a curry? You say, I can't do that. In valuation, if all you do is value steel company after steel company, you might get really good at valuing steel companies. But I come to you with a tech company, never done that before. So I'm going to make you get out of your safety zone and value companies that you don't feel comfortable valuing, because that's how you learn valuation. So that's the first thing. The second one, and this is something you see me return to over and over again, is I'm going to draw a contrast between two words that we use interchangeably in valuation that we should not. The words are value and price. Let me back up. We know what determines the value of an asset or a business or a company. We've always known this. It's cash flows, growth, and risk. You can dance around this, create elaborate models, but it's cash flows, growth, and risk. When I say we've always known this, we act like we invented valuation 100 years ago. But that Venetian glassmaker who sold his business in the Middle Ages thought about cash flows, growth, and risk probably more directly than the people today, with all the models kind of confusing them. So value is driven by cash flows, growth, and risk. You have to understand the business to value a company, because without understanding whether you're in a high margin business or a low margin business, what are you going to do? Probably my Zoom. What the heck is that? Whatever it is, I have no idea. Yeah. So value is driven by cash flows, growth, and risk. You know what determines price? Demand and supply. You think about demand and supply driven by cash flows, growth, and risk? Maybe. But you know what else determines demand and supply? Mood, momentum, revenge. You say, what? Revenge? Early in 2021, there's a company called GameStop. Remember that? GameStop is this company that used to be in malls. In fact, you guys are probably too young to remember when GameStop dominated mall traffic. My kids would always want to go into GameStop because you could play games and see what the games look like. But it's a dying business. Dying business. Why? Because malls are dying. Everything's moving online. So by the start of 2021, GameStop was on its pathway to an end. The game was over, the business, and the stock price had dropped. It was one of the most heavily shorted stocks on the among US equities. You know what shorting is, right? People were selling it to return basically because they thought the price was going to go to zero. Then early in 2021, something magical happened. A group of people gathered together on a Reddit site called Wall Street Bets, and they decided to buy GameStop. And they succeeded even beyond their wildest imagination. They pushed the price up from $15 per share to $400 per share. I was puzzled. I said, what is it that they see in GameStop that makes them believe that this company could be worth $400 per share? So I went on the Wall Street Bets site. It was torturous reading through the rationale. But here was the overwhelming theme that came through. You know why they were pushing the price up? Not because they thought GameStop was coming back or because, they thought the founder of Chewy, Ryan Cohen, was going to turn the company around. They were doing it because they wanted to get revenge. Against whom? Who were they trying to run out of business? Hedge funds. Why? Because they had big student loans and they're convinced that if Citadel hadn't done this, their student loan would have been half what it was. Whatever the reason, it was revenge. You think that makes no sense? It makes complete sense. Think about it. What's a stronger human emotion? Revenge or rational thought? It's no brainer. What I'm trying to say is price is driven by lots of forces that have nothing to do with fundamentals. In fact, there's a whole area of finance we've developed over the last 40 years to try to explain why price can deviate from value, called behavioral finance. What does it do? It takes psychological insights into how people behave and say, hey, that's why stock prices can stay higher than value. As I said, this class, I'm going to draw a contrast between value and price. We're going to talk first about value, and we're going to focus a lot on cash flows, growth, and risk. But many of you, when you go out there for jobs, you're not going to be valuing companies, you're going to be pricing them. What do you think banks do? They don't value companies, they price them. We're going to talk about how to price companies better, because in pricing, here's what you do. You look at what other people are paying for similar, lots of subjective judgments there, similar companies, and you pay based on that. So people are paying a lot for other user-based companies. They're paying $100 a user, and you have 300 million users. I put your value at 30 billion. We're going to draw the contrast between value and price, because I think even among people who claim to have done valuation for a living for 30 or 40 years, there's a tremendous amount of confusion about what exactly they're doing. That's not a good place to be. So we're going to draw that contrast, value versus price. Third thing. This is a class about valuing just about anything. And what we can't value, we will price. So this is not just about valuing, publicly traded large companies. It's about private companies and public companies, young companies and old companies, developed market companies and emerging market companies. And guess what? The rules stay the same, no matter which of those companies. So we're going to start with that. We're going to talk about how to value just about any asset with cash flows. But how do you value Picasso? You can't value it. You can price it. How do you price Picassos? What did I say you do in pricing? You look for what other people are paying for similar assets. With a Picasso, and you're an appraiser, let's say that's your job. What do? You look to see what other people have paid for Picassos. You say, this is a bigger Picasso. I don't know how you do this, but that's why I'm not in the, but remember the Mona Lisa lookalike that the Saudis bought for like 400 million? You know why it went for 400 million? It's an awful looking picture, if you ask me. But because the Mona Lisa is worth so much, this must be worth 400 million. So we're going to talk about pricing as well. And in that process, we can talk about pricing, not just companies. We can talk about pricing. Real estate, remember, is all pricing all the time. You know what I mean by pricing? If you buy an apartment in New York City, first, you must be really rich. But if you do, think of how the realtor comes up with a number for the apartment. They don't do a discounted cash flow valuation of the apartment. They look to see what other pricing is more the norm than the exception. And in the process, maybe we'll ask the question, how do you price Bitcoin? You can't value Bitcoin. Why can't you value Bitcoin? For the same reasons you can't value the US dollar. If it's a currency, you can't value currency. You can price it. You call it an exchange rate. Think of the price of Bitcoin as an exchange rate. And I think that's a healthy discussion. Is Bitcoin a good currency? Would you be willing to give up $20,000 for one Bitcoin, which is what people are? And that's a discussion we can have, and that's a fair discussion. But you'd be amazed at how often people say, what's the value of Bitcoin? Do not use the word value for assets that don't have cash flows. You can't, you can price Bitcoin, you can price a Mickey Mantle rookie card, but you cannot value those because there are no cash flows. And along the way, we'll also talk about the one aspect of this class where you draw on things that have happened. Much of this class, you draw on core principles that have been around forever. But in the last 50 years, we've had these option pricing models developed primarily to value options. In this class, we're not going to use them to value options. We're going to value companies or businesses or assets with contingent cash flows. Sounds mysterious, right? But let's suppose you have a young pharmaceutical company. It's working on this vaccine for something that nobody's ever seen before. It's an mRNA vaccine. You're probably saying, who's ever going to need that vaccine? 2018, 2019. You're buying a contingent cash flow. If the vaccine gets approved, this company could be worth billions. If it doesn't, it's worth nothing. You're not valuing a traditional asset. So we're going to talk about sets of businesses or assets which have contingent cash flows, and we're going to use those to value not just young pharma companies, but a platform. How many times have you seen people say, well, I have 300 million users on my platform. I haven't figured out how to make money. And a few years ago, 2 years ago, I valued this company called Paytm. And I made the mistake of putting its app on my phone. Paytm is this Indian online payment processing company. And every day they offer me free stuff. You know what they're very good at? Adding users. You know what they're not good at? Figuring out how to make money on those users. And the question you ask is having 350 million users, which is what they have on their platform, worth something? The answer is absolutely. If you get the right people running the company. We're going to use option pricing to value assets like those. Which brings me to my fourth theme. And this goes back to the question I asked you. What are you more comfortable doing? Telling stories or working with numbers? And at that time, I said, you probably are thinking right now that good valuation is all about numbers. And if you go to work for an investment bank, that's what you become, right? An Excel ninja. You open up these big models and you take line item after line. Bankers can't value $20 in a brown paper bag if you put in front of them, but they can build elaborate models to show you that $20 is really worth $50. We're in a bad place in valuation because of two developments. And this is going to sound contradictory. You know what the two developments are? The first is we have far more data than we used to have. That's good, right? The second is we have more powerful tools than we ever did. And here's the contradiction. Even as the amount of data we have and the tools we have become more powerful, our valuations are actually getting qualitatively less good, not better. And the reason is we tend to hang out with people who think like us. You go to work for a bank, you're all Excel ninjas. You think every valuation is line item 15, just get that line item right. And I think we need to step back. We'll come back and talk more about this process. But a good valuation is a bridge between stories and numbers. See, what are you talking about? When I value a company, we're going to put my Tesla valuation out tomorrow. You know what my revenues are in 2032 for Tesla? About $400 billion. The revenues right now are about 93 billion. So I'm quadrupling revenues. And you ask me, why are my revenues 400 billion in year 10? You know the answer you don't want to hear is? It's because I used a 25% growth rate for the next 5 years. And it tells you absolutely nothing, right? I need to tell you a story about Tesla that explains the 400 billion, that electric cars are going to dominate the automobile business and that Tesla is going to have a dominant market share of that business. And you can then ask me to defend each of those, but that's what you need as an answer. I'm going to use a margin of 20%. You know why that should surprise you? Because a typical automobile company has margins of 8, 10, 12%. A software company has margins of 30, 35%. So when I use a 20% margin and you ask me why I'm using the margin, I should tell you a story about Tesla that's a mix of automobile and technology that says, look, this is not a traditional auto company. An electric car is more iPhone than Chevy. And because of that, it can have higher margins. Again, I could be completely wrong, but every number in my valuation has to have a story to back it up. And every story you tell me about a company, you about some of the stories, right? Great, amazing brand name, great CEO, top technology, has to find a number that goes with it. So if you're a number cruncher, you need to get comfortable with the storytelling. And if you're a I'll tell you my vision for this class. If you're a number cruncher, by the end of this class, I hope you trust your imagination enough to be able to tell stories. Because remember, you've spent a lifetime bludgeoning that poor thing into the ground. Because at every step, if you're in a number crunching class, if you come up with something imaginative, push that down, go back to the numbers. And if you're a storyteller, I hope by the end of this class, you develop enough discipline to not tell me fairy tales. Get comfortable enough with the numbers. So to me, the essence of somebody who's good at valuation, you're either a disciplined storyteller or an imaginative number cruncher. Been teaching this class for 37 years. Guess which group I always have more trouble with? Getting storytellers to develop discipline, or number crunchers to tell stories. It's not even close. It's always the number crunchers. You give me 100 history majors, I can teach them enough valuation to be able to value companies next week. Give me 100 engineers, I am screwed. So if you're a number cruncher, I need you to let go of that need. Because if you're a number cruncher, you always want closure, right? Until you get that absolute certainty, you got this right, you can't let go. You need to let go. There's a point in valuation where you have to take the karmic view. You know, the karmic view is, I've done everything I can. I've made my best estimate. It's time to move on. Because if you get stuck on an input saying, I need certainty, you're never going to get closure. How the heck could you ever feel certainty about how many electric cars are going to be sold in 2032? You're not God. If you've been operating under that delusion, you're far bigger problem than this class. But there are things you and I can never figure out because there are too many uncertainties. Which brings me to my final theme for this class. I'm going to use a word that you probably don't expect to see in a valuation class. It's faith. Think what's faith got to do with it? Everything. I'll be upfront. I don't do consulting. I don't do expert witness work. In other words, I don't do valuation for others. So what's the only reason left to do valuation? Because I'm curious? Come on. I have far better things to be curious about. I do valuation because I want to act on my valuations. You know what I mean by that? I value a company, and if I find Tesla to be undervalued, I want to be able to buy it. You think, what's the big deal? To act on your valuations, you need faith. First, faith in your value. Do you see why you need faith in your value? You value the company, you followed all the rules, but you need to say, I trust that number. And second, faith that the price will adjust to the value. Why am I using the word faith? What's the essence of faith? If you ask me to prove that my value is right, I'm going to say, I can't prove it. If you ask me to prove that price will adjust to value, I can't do that either. So think of it as the equivalent of going to church or temple or wherever you go and asking the priest, can you prove to me that God exists? And unless you have a priest who makes up stuff, he's going to have faith. Probably pisses you off to no end because they give me proof. And faith is not something I can teach, but I can talk about why I have faith and when that faith has been shaken. I've never had much patience for people who talk in absolutes, like all those people to go to Omaha every year, the group I'm talking about, who think that they have the answer because Warren Buffett has told them the right answer. I don't have that much. I don't believe in that absolutism. I estimate value, but you know what? My faith is always being tested. I'll give you an example. Let's say I buy Tesla tomorrow at 135 or whatever it's trading at right now. And it's because I think the stock is worth 165. What happens the day after the stock drops to 115? It's the market knocking on your door saying, do you still have faith? Get used to that. That's the nature of investing. And most people don't have faith. So that's something you have to decide for yourself. And you might decide you have no faith, in which case, what should you do? Buy index funds and move on. Live the rest of your life. You can live a perfectly happy life without ever buying a stock and making money. Trust me. But that's a healthy conclusion to arrive at. So that's something to think about as you get through is, do I have faith? And the first time you value a company, don't be surprised if you're a little shaky about, is this a value? Maybe I got something wrong. It's natural. If you don't feel any questioning, there's something wrong with you, right? If you say, I'm absolutely certain about this number, how the heck did you get that much certainty? You're either a sociopath or you got a direct connection to God that I'd love to have as well, because this is not something you can feel sure about. So let me the outline for the class. We're going to start with the first few sessions focused on the big picture, how things connect together. Now, the reason I do that is often when you start to dig into the inputs, it's easy to get lost. So when we talk about risk premiums, you're saying, why are we talking about this again? Betas, what has that got to do with? The big picture is basically going to frame everything we're going to do in the class and where things fit in. So when we get there, you're saying, okay, that's why we're doing this. Then we're going to move on to the inputs into intrinsic value. And what did I say? There were cash flows, growth, and risk. We're going to talk about how to estimate those as best as we can, given the data we have. And we're also going to talk about loose ends in valuation. How do you tie up loose ends? What do you do if a company has a lot of cash? What if there's a lawsuit hanging over the company? Okay. Then we're going to move on to the pricing part of the course. So, and in the process of the intrinsic valuation, we will, towards the end of the intrinsic valuation section, actually value entire companies. So you can see all the pieces come into play. Probably going to value 15, 20 companies, very diverse, from young startups to old companies. We'll value them. Just to depress you, I'll value Bed Bath and Beyond. It's already depressing if you've gone into a Bed Bath and Beyond, which I think is an incredibly depressing experience, but valuing it is even more depressing. You say, how did the company ever get to this point in the first place? Then we're going to talk about pricing. And in the process, we're going to talk about standardizing price and comparing across companies. You say, what do you mean standardizing price? You can't compare the price per share across companies. If you did, what's the most expensive company in the US? If you just look at the price per share. It's Berkshire Hathaway, which is what, $400,000 per share, $350,000 per share. And the cheapest stock is some penny stock, right? But that's absurd because price per share is arbitrary. Why? Because I could do a 2-for-1 stock split and my price goes down by 50%. Doesn't make any cheaper. And because we can't compare price per share across companies, we divide the price by something to standardize things. Like what? Like earnings, price-earnings ratio divided by book value, price-to-book ratio, just a standardized price. And in the process of pricing, we're going to look at different multiples and how to do pricing better. Once we've got intrinsic valuation and pricing done, we're going to talk about asset-based valuation. What is that? You look at a company and rather than value the whole company, you value it in pieces. Right now, for instance, if you have to value GE, there's no company left. It's a walking dead company. But you have pieces, you know, the healthcare business, the aircraft business, the GE Capital. We'll talk about some of the parts, asset-based valuation. We'll spend a session on valuing private business. You're saying only a session? Because to value a privately owned business, you don't have to change the rules, still cash flows, growth, and risk, but you have to bring in some special perspectives. Like what? Like the fact that a private business might depend on its owner a great deal more. So if you have a plumbing business, it's not just a business, it's a plumber. The plumber has, you know, links to businesses. And if the plumber basically passes away, there goes the business. It's called a key person component. And it's not just private businesses, right? We just mentioned Tesla. One of the questions I've always had with Tesla is, what would you do if you woke up one day and you looked at the news and it said, Elon Musk checks into rehab? First, would you be surprised? Probably not, right? He's an amazing guy, but he clearly seems to have some issues. Okay? What would happen to the value of Tesla as a company? This has always been the question that overhangs the company. But in private business, it's front and center. So we're going to talk about what you do differently in private company valuation. You're going to be surprised. 90% you do the same, but there are 10% of the time you do different things. We'll talk about those. And then we'll bring in this option issue. And that's what we talked about, valuing young pharma companies or valuing a platform, how option pricing can help you. So that's basically the structure of the class. In sessions 26 and 27, I'm going to focus on special aspects of valuation. One is acquisition value. What's different about valuation in M&A? And the answer is nothing, other than the fact that people like to overpay and their bankers basically want the deal to get done. We'll talk about some of the ways in which bad deals get a pathway to getting done. And in the second to last session, we'll focus on how do you change the value of a business. You know why that matters? Because much of the class we're going to spend looking from the outside in at companies. In that session, I'm going to take you on the inside. Say, you're the CEO of Disney. Stock's doing badly. Value's probably dropped. What can you do to increase the value of the company? It's my corporate finance compressed into one session because corporate finance, I teach corporate finance and valuation in the MBAs. The MBAs always ask me, what's the difference between the two classes? I said, it's the same class, I just give them different names. It's actually, the principles are the same, but in corporate finance, you look at companies from the inside out. In valuation, you look at companies from the outside in. And session 27 is going to be that inside out view of companies. So if those of you are interested in running your own business, going into consulting, this session, you can talk about the levers you can look at, say, how do I change the value of a company? So that's the structure of what's coming. In terms of pre-season prep, it's probably too late because the season's already begun. You should have 3 emails from me already, right? Starting today, you're probably going to get an email every day for the rest of the semester. But in the very first email, I said, look, I'm not going to call on, you don't need to be a math genius, but the 3 skill sets I would like you to kind of brush up on. The first is, much as I dump on accountants, our raw data comes from accounting statements. If you are uncertain about what the difference is between operating income and net income, don't admit to it right now. But I have a 12-session class in accounting, and I'm not an accountant. I teach it my own way. Accountants probably were horrified by what I teach in this class. But it's about learning just enough accounting that you can make it through that raw data. Second, I have a statistics class. Why? Because what did I say in the biggest change in valuation? Huge amounts of data. We're drowning in data. And we need to figure out ways to take that data and make it manageable. That's what statistics should be about. That's unfortunately not how statistics classes get taught. So again, I have my own version of a statistics class on my website that you can take. It's 12 sessions. Now, if you still don't know what a multiple regression is or why you should care, maybe you should watch that class. And the third is foundations of finance. If you still think present value is a button on your calculator, and you really don't get the intuitive foundation, I would strongly recommend taking that foundations class because 90% of finance is present value. And understanding what it is that drives present value and why it changes is critical to doing this right. So that's pre-season prep. For many of you, you might not need it because you feel ready. But I told you I'm going to, that for the next 15 weeks, I will take over your lives. I'll tell you how I'm going to take over. The week starts on Monday. You'll have class, and right after the class, like today's class, you get an email from me. You know, the email will contain what we did in the class, but I was just in the class. I know physically you were here, but there will be days where physically you might be here, but mentally you might be elsewhere, and say, if you left the class mentally, here's what we did during the class. Tuesdays, you'll get a valuation of the week. What is that? I'm going to pick a company to value. Like next week, I might put out my Tesla valuation with my post on why I value the company. Then I'm going to invite you to value Tesla on your own. Your reaction is going to be, it's only week 2 of the class. We haven't learned enough. Just do whatever you feel comfortable doing. So in the first valuation, you might change the 3rd decimal on the risk-free rate, leave everything else at my numbers and tell me, look, I got the same value that you did. I'm just going to let it go. Because that's not healthy that you all get the same value. But every week I'll put up a valuation of the week and I'll go all over the place. I think one of them is the valuation of the Los Angeles Clippers when Steve Ballmer bought it. So we're going to value companies, we're going to value businesses, and I'm going to, remember I said I want to get you out of your comfort zone. So across the next 15 weeks, you're going to value 14 companies, essentially very different companies. And here's what's going to happen. It always happens. I feel comfortable making this prediction. As we go further and further into this class, you're going to find yourself more willing to disagree with me. And that's good. It's good because you say, I don't like your growth rate. I'm going to use a low growth. Good. That's what valuation should be about. We should be debating the story and the valuations. So Tuesday, I'll send out a valuation of the week. No grades. So if you completely ignore these valuations of the week, I'm not going to, chase you down and say you didn't do the valuation of the week. But I'm going to create a Google shared spreadsheet. Think of this as a crowd valuation. I'll put my valuation in the first row, and each of you, as you value the company, can put your valuations down. Let's see what the crowd valuation of Tesla works out to be. So you can see what the typical value is, what's high, what's low. Now, on Wednesday, we will have another class, obviously Monday, Wednesday. And on Wednesday, you will also get what's called a weekly challenge. What's a weekly challenge? Every week we'll cover something. Like next week, we might cover risk-free rates. In the weekly challenge, I'm going to take whatever we did in class and make you stretch. Can you estimate the risk-free rate in zombie and quacha? And if you've been in the class, you'll have the tools, but it'll require that you get creative, try it out. Again, completely optional. The way somebody described this class, like drinking out of a hose. So water coming at you. You might decide, I don't like this, I'll just take a little trickle. So, but I'm going to give you the hose and you can decide what matters. On Thursday, you get an email from me reminding you where you should be on your project. You're saying, what project? That pain is coming. I'll describe it to you. But your project already, you might not realize this, but your project already started the minute you walked into class. And I'll talk about that project. And every Thursday is my nagging email. So where are you? Because I know exactly what you guys will do. Because the project is not due till May 8th. Many of you will not start even thinking about the project till April 23rd. I can't stop that. But I can nag you, and maybe the guilt will build up to a point, oh my God, I'm way behind. So I'll send you a timeline. Here's where you should be. It's like a GPS. So I'm not there yet. Yeah. Maybe you will respond, maybe you won't. On Friday, I will do a webcast which applies in practice. So for instance, when you talk about risk-free rates, I'll do a webcast on how I estimate a risk-free rate in Indonesian rupee. I take you through where I get the data, how I clean up for it, so you can see it play out in practice. On Saturday, you get a weekly newsletter. Don't look at this for breaking news. I'm not CNN. But the newsletter will basically summarize what we did that week, what you might have missed if you were away for the week. So again, because let's face it, when you're in a class with 350 other people, it's easy to get lost and feel that nobody's noticed that. I'm going to try to catch you if you get lost. And these are all my devices to kind of keep you connected to the class. On Sunday, I'll send you the weekly challenge. Remember the one I sent you on Wednesday? I'll send you my solution. But again, it's not for grading. So if you worked on it, you can compare your solution to mine. And then you wake up on Monday and we'll repeat the process again. So that's the structure of the class. And I'm not doing it to scare you, but just to get you a sense of where. In terms of the logistics of the class, while I will do Zoom sessions, I would like you to be in the class. I don't think it's that painful to be here, but I understand, sometimes you might have to travel. So there will be the live Zoom, it'll be recorded. So basically you can catch, there's no excuse for falling behind. So even if you're sick at home, you should be able to watch the lectures. If you're trapped in a foreign country, don't ask me why. You're a spy, you've been arrested, you've been thrown into a Turkish jail. Ask for a Wi-Fi connection so you can watch the classes. You don't, you can bring, if you can bring, there's only one thing that you need for the lectures, your lecture note packet. I sent you the link to the first packet. I've told the bookstore to print it, but by the time they do it, the class is usually over. And why do you want to pay those guys that overprice issue anyway? So keep it digitally if you want, because you can make the notes on it. If you want to print it, just don't do it on the printers downstairs, or wherever they are now, because then I hear about it. Because it's like, I think we have 800 pages of slides for this class, and 350 times 800, you can work out the math will break every single printer down here. So if you're going to print it, please pay the money, go to wherever you need to print it. Or if you're working for somebody, they have no idea what's being printed anyway. Just print it off on the side, as you leave 350 pages. I don't know what that is, and then grab it. I'll put in the recycling for you and you can take it home. So I'm not encouraging you to break the, maybe I am. But if you do miss a class, catch up. There's no reason. Now, do you need a book? No, you can live without a book. But I do have 5 different books on valuation. You go to my website, I compare them. But basically, let me go down the list. The only one of these books that's a textbook. It makes a textbook different from a trade book. First, it's priced twice as high. Why? Because you're college students and they exploit you, and I hate that. But if you're doing the investment valuation, which is a textbook, there's a trade book version of this book, which is exactly the same book. And to show you how crazy publishers are, the textbook version sells for like $80, and the trade book, which is actually hardback instead of paperback, sells for $45. So my advice is buy the cheapest version of this book you can find. And if you go to Asia and you can get it for $22, all the more power to you. This morning I was talking to somebody who said he bought my book outside a train station in a city called Indore, which is in India. And he said he paid $1.50. It's completely pirated. And I said, you know what? Whatever rings your bell, because, let's face it, I'm not making money off these books in the first place. So no, so do whatever you can if you need a book, but if you're fine without a book. Incidentally, if you have an Apple device, I have an app that I co-developed with a friend of mine, Anand Sundaram at Dartmouth, which will do an intrinsic valuation of a company. So if you go to the Apple store, type in U-Value, which is the name of the app, you can download it. It comes with a money back guarantee. You know why? It's free. So if you don't like it, tough. Keep it, throw it away, take it away. But basically, it does a pretty good job of an intrinsic valuation. I'd put it up against any banking valuation of a company. So if you want to buy a book, feel free to do so. Incidentally, during the course of the semester, my new book is coming out. It's on corporate life cycles, and something I talk about during the course of this class. So if it does come out, I'll let you know when it's available. Now there's more stuff. If you want, almost everything for this class is on that page that's listed up there. So if you go to that link, that's the central clearing point for this class. Whether it's lecture notes, whether it's webcasts, everything is centered there. So rather than go to Brightspace, that's where I would go for all the material for the class. Every one of the lectures that I do will be converted to YouTube video. So after I get back to my office in about 20 minutes, when I get the notification from Zoom, assuming it worked today, and I get a recording, that recording will become a YouTube video and it'll become part of a playlist. So the nice thing about YouTube is you don't need bandwidth. So if you're on your phone and you're on cell, rather than download a video file, YouTube allows you to kind of watch it. And every email I sent, I told you that the 3 so far, 1 every day, will become part of what I call the email chronicles. Why I do this? Everything is about me. It's to protect myself, because I know what you're going to say about 6 weeks from now. I'm going to say, remember that email? You say, what email? I didn't get it. No excuses here, because every email that I sent will be in the email chronicles. You can go check out. So if you're blocking emails, unblock me at least for the next 15 weeks. After 15 weeks, I couldn't care less if you block me from that point on. But it's my device for connecting, making sure that you're with the class. There's a Google Calendar that I sent you the link for, so you can see when the quizzes and the exams are. Okay. My blog is where I pretty much write whatever. I sent you the first 2 data updates. The last one was just 3 days ago. The Tesla post will go up sometime this week, hopefully by Wednesday. I have a Twitter feed where you can, where I don't get into Twitter fights. There's no tweet contest, but basically whenever something is new on my website, that's my way of connecting. And if you still have time on your hands, I don't see how you would. There are more, when you want to read more stuff, there's a link again on my website, which will take you to more readings on each of the topics. Now, of course, the big question you have is, what's my grade going to be? So here's how I think about this, right? I'll have to come up with a device. If by the end of the class, you can value just about anything, then I'm going to try to give you an A or an A minus. If you can value most things, think of that as your B territory. If you can value something, which is not asking for a whole lot, it's a C. If you can value nothing, then I've failed at my job and you've failed with me. Okay? So this shouldn't be new. This is the grading distribution for all finance classes. Of course, strategy, everybody gets an A. No, but in finance, we don't give everybody A. So it's a nature of the beast, which means there are going to be some of you who put in a lot of work for the class. At the end of the class, you can say, I got a B on this class, but I put so much time in. That's the way it is. In terms of how you're going to get graded, There is going to be a valuation project, which I will start the next class talking about. But here's what I'd like you to start thinking about already. I want you to start thinking about a company you'd like to value and price over the course of the semester. And don't think about what will be an easy company to work with. Pick a company that you're interested in. Either because you've always read about them, and it could be Netflix, it could be Palantir, it could be it could be Alibaba, it could be any company you want, because that's going to be a project, and they're going to be 3 quizzes for this class. The dates are listed. Each of these quizzes is worth 10% of your grade, and a final exam, which is worth 30%. It's not quite time yet, so please. All of the quizzes and exams will be open book, open note. So this is not about testing you on equations, it's about applying things. Okay? And I know that you might have to miss a quiz. So if you get a chance and you go to the last page of this packet, it tells you all of the rules that go with quizzes. Please read through the rules, right? The rules are simple, which is if you're going to miss a quiz, you have to let me know before the quiz. Because I can't keep track of who's coming. So I can't give you the option, take the quiz and put it in your backpack. And if you do miss a quiz, the 10% gets moved to what's left in the class, not back, but always forward. So take a look at the rules, because when we start next session, we will start with the project, and then we will be diving into the first part of the class. So see you on Wednesday.